Thanks everybody for being back on time. That's great. So we're going to start with Sven, who's going to give us a brief introduction on some of the key elements in the market, looking at logistics, and then we'll pick those up in the panel. And again, any views on those, please do share them. Any questions, do come in. But welcome, Sven. Thank you.
Thank you very much, Richard. I'll also use the microphone. I didn't do 10 presentations or 5 presentations on logistics in the past 2 weeks, but yesterday, Dominique was there as well, almost a similar story. So the demand for logistic insights is growing again. We had some record years over the past 5 years, and there was a lot of demand on what is the limit in terms of rental growth? How low can the yields go? Well, the story now is different. I can spoil that a bit. The market is completely different compared to 2-3 years ago. Just in COVID, we had take-up volumes which didn't seem real. The market was changing. There was a lot of risk from a supply chain perspective in the market, and therefore demand became much more domestic. Now we are seeing different trends, and I'll try to bring you through that story. What are we seeing from an economic perspective? What are we seeing on the occupational market, and slightly touch on the investment market? The panel before, and Reinoud already touched on it a bit, but I'll try to give you some insights on the latest volumes, pricing levels, Netherlands compared to the European perspective, because we're always competing with other countries when it comes to attracting capital to our country. From an economic perspective, what are we seeing? So we are coming from a very volatile period, high inflation rates, low-digit GDP growth numbers. We're now starting to see some positive trends, some slight upturns that we are seeing. So we are seeing CPI inflation becoming more stabilized. Of course, important for the predictability. It's having its impact on decision making on terms of interest rates. What's the ECB going to do going forward? What are we spending? What is our spending power, etc. So small positive signs also in a wider international context that inflation rates are starting to stabilize. And that has been touched before. From a macroeconomic perspective, the market was very unpredictable. Something that investors don't like is unpredictability. Now it's becoming more predictable to have a cash flow for the next 10 years and to estimate what your market rent would be. So that helps in your decision making from an investor's perspective. If we look at GDP growth, these numbers, apologies for that, are already slightly outdated. But what we have seen earlier this week is a slight upturn of 10 basis points in terms of GDP growth for the Netherlands in Q2. So CBS said it wasn't 0.1%, but 0.2% growth. So luckily, it's better than they predicted, and hopefully that trend will continue. What are we seeing in terms of longer-term GDP growth is that the impact isn't yet visible in terms of the tariffs that we have agreed upon within EU with the US. It's still very fresh, has been agreed upon in August. What we've seen so far is that our trade plus with the US is still there. There's no trade deficit. It didn't really impact our trade volumes. And as a trading nation, that's of course a very strong fundament with 2 main ports, Rotterdam, Amsterdam, and for the story I'm about to tell for logistics. So from a trade perspective, that at the moment, but still fresh, there hasn't been any downturn after the trade agreement with the US. But what are we seeing in terms of a European scale? Unfortunately, the Dutch market is lagging. We've seen some record-breaking years, and we started off very, very slow in 2025. Where we've seen, and I'll touch on a few of those topics as well, strong rental growth, historic low vacancy rates of almost 1%. Now the market, it's not about shortage in supply anymore, which is withholding demand in the market. It's now the occupational market, which started to slow down. Decision making takes longer. if you are thinking about moving your logistic operation, it's very costly, and that's starting to impact the movement of logistic operators across the Netherlands. The strange thing is that other countries had that already in the last 1 or 2 years, and they're now starting to pick up. So the Netherlands is slightly in a different cycle at the moment, especially when you compare the first half of 2025 to full year 2024 and 2023 volumes. Although if you compare our current volume, almost 700,000 square meters of take-up, to that long-term average, and also the pre-COVID levels, then it's quite a normal volume. And for me, it's also still a period to get used to those new normal volumes. I still think about those record years. A lot of brokers made a lot of money on the occupational market for logistics, but also the investor market. And those are still the dreams that we might have during the night. Okay, it was that great. Now we need to get used to the normal levels. And normal, I mean 2.5 million square meters of take-up each year. And that's not nothing. It's still quite a dynamic market, but it's still something to get used to. But also on the occupational market, as said, we're lagging, and here you can compare on a quarter-by-quarter basis, lagging in terms of 2024, 23, and the record years. What are we seeing going forward for the second half of 2025 is that we'll probably just end up below that long-term average. So between 2.5 million square meters. So there's still a lot of work to do. Hopefully the third quarter will already show some increased appetite for doing some larger leasing transactions. And mostly Q4 is the most dynamic quarter of the year, so always very optimistic about year-end data figures. And that will probably mean between 2 and 2.5 million square meters. Demand is coming from, which is interesting to me, and I spoke to a few of our brokers, much more from the APAC continent rather than the other two continents, US, EMEA. There's not a lot of demand coming from those regions. We are currently experiencing a lot of demand from APAC retailers and APAC 3PLs. Could do with changing legislations in terms of the tax rates that are being impacted for flowing goods from Asia to Europe, which will now be fully having an impact because we had up to, I think, amounts of 20 euros, no tax being applied, and that will change over time. That each good that is coming into Europe needs to be paid by, has a payable tax on it. So that might impact good flows from Asia to Europe, and that's probably why we'll see some stronger demand from Asian companies coming to the Netherlands. In terms of supply, so I said already, over the past few years, it was mainly a supply-driven challenge that we couldn't meet occupier demand in the market. Hence, that's why we've seen strong rental growth in the past. Across Europe, at the moment, we are seeing that vacancy rates are increasing. And the general picture is that it's still a quality discussion, so there's not enough quality in the market available. But it also differs by country, and we'll touch upon the Netherlands in a second, of course. But it is interesting to see that the wider European trend, vacancy rates for logistics space, so the big boxes, is increasing. So I'm talking here about, I had to say that at the beginning of the presentation, it's big box industrial space, logistics space. So it's not urban logistics, the small sheds that we see close to the inner cities. It's big box logistics, what we are here talking about. And for example, Amsterdam has currently a vacancy rate, and I'll zoom out to the Netherlands in a second, of higher than average. That has to do with some big developments that occurred here in the city, which are still vacant after completion. And that's strongly impacting also the potential rental growth in the market. We've seen already strong rental growth in Amsterdam over the past few years, especially Schiphol, and now with rising vacancy rates, that's starting to stabilize. What are we seeing in the Netherlands in terms of quality and vacancy rate? So as said, historically in the Netherlands we had a vacancy rate of around 1%, and you can imagine what that does with rental rates. If there's more demand than supply, less economics, rents go up. And for me, that was the first time in the logistics market that we saw double-digit rental growth, and not only 10%, no 20, 30% in some markets. And I'll show you a map of what current rental rates are across the Netherlands to show you the current market composition. What's impacting now and how the market is now changing is how vacancy rate started to increase. So from that 1% vacancy rate to a 4% vacancy rate, it's still not a lot, of course. There's still more demand than supply, but there's more occupier choice now in the market. So hence that's why rents are now starting to stabilize. And our expectation is that this trend will continue. We are seeing some developments coming to the market, hence that's why we also have a quite larger grade A supply available in the Netherlands compared to some other countries. So we have some high quality space available, but that's mainly in tier 2, tier 3 locations, so locations from an occupier perspective which are slightly more difficult to lease. And the grade B and C part is more the obsolete space being left behind, which definitely needs some heavy asset management or maybe some redevelopment to reposition itself. For that part of the market, we think that it's quite difficult to lease up that space, and rent levels are definitely much lower. The time that you had an occupier already standing in line before you could hang up a for lease sign, that's definitely over. It now takes longer to lease, your incentives are increasing, and I even have my doubt if we might see some decrease in rental levels, but I'll touch upon that in a second. Also, that vacancy story strongly differs across the Netherlands, of course. We always, the ones who are active in the logistics market maybe know the blue banana shape, which is often being drawn over the Netherlands with the main hotspots. That starts in Amsterdam with our main port, where we have Schiphol Airport and the Port of Amsterdam, going into Rotterdam, over the south of the Netherlands, via Venlo into the German hinterland. Those are the locations in the Netherlands where we have multimodal modes of transport, where on an annual basis 70 to 80% of occupational demand is located. So strong logistic locations with very strong fundamentals based on infrastructure, which we can't really change, and there's no need for change. And where there's also population living who wants to work in logistic facilities. So vacancy rates across the Netherlands strongly differ. What we've seen in the last couple of years is that the prime locations have the biggest shortage of land. So we've seen some developers going into more exotic places. You can imagine now, if you see the bluer spaces, which those locations are, those assets are slightly more difficult to lease, and some of them are still vacant. What are we thinking to see going forward? So as already said, there are some challenges in terms of new development potential. So in the Netherlands we have a big discussion around boxification, verdozing van het landschap. That's not gonna change, probably not after the new elections. I don't foresee a new parliament becoming in state that is very keen on getting more logistics space into our landscape. They will probably continue to push for less logistics rather than more. Additionally, we have grid congestion, nitrogen, etc., which makes it difficult to build commercial real estate, and especially big box real estate like logistics. So what we foresee, and it's easy to predict, is a decline in development volumes. So we had that record-breaking years where a lot of the new space was taken up by occupiers already pre-committed to some of the new build space. Now that's starting to decline, with the reasons as just explained. And the Netherlands is not alone in that trend. We also see that in other countries neighboring us, like in Belgium, in Germany, and probably much more markets to follow in those footsteps. If we want to look at how then supply, demand are coming together, the most shortage markets offer the biggest opportunities from a rental perspective, of course. If you want to grow your market rent, we've seen very strong market rent growth already in the Netherlands. and that's now starting to stabilize. But we still have a big shortage if you compare supply demand. So these are the years in terms of supply which is available in the market, and that's still very short. So probably we've all learned what frictional vacancy is, so around that 2 to 3, 4, 5% vacancy depending on the market. This is still a very scarce market, but given the rental growth that we have already seen, market is stabilizing. Compared to Germany, what we've seen there is also a very stable trend up to 2017, 2018. Market rent picked up there already slightly sooner and is also now starting to stabilize. And that's quite a common picture across Europe, that stabilizing rent levels, because the most of the markets already saw 10, 20, 30% rental growth. And this is the picture as of today. I didn't include the rental growth percentages, but when I zoom back to 5 to 10 years ago, most of the rental rates across the Netherlands were quite easy to predict, around 50 to 60 euros. I live in Tilburg, for example. Back then it was 50 euros. Now it's 40 euros up, so it's almost in a few years' time, 40, 50% rental growth, even doubled over there. So we've seen the market really changing in terms of rental rates, and this is for new builds. What we are now seeing with vacancy increasing, occupier choice increasing, is that investors are slightly becoming more aggressive, and the willingness to sign the lease is growing. So incentives, we've already seen those increasing over the last couple of 6 to 9 months. From a research perspective, I think we're gonna see, not sure if everyone agrees, some downward rental pressure on logistics. Probably first seen in average rents that are being signed and calculated. Maybe for new builds, very high ESG credentials, we can keep up with these rental levels, but there will definitely be some downward pressure if rents or if vacancy will continue to rise. Is it all bad? No, of course not. It's not that we'll see some huge impact on capital values. We've seen already, as already said, some very strong rental growth, and we are now starting to see the first sign of yield movement, yield contraction. Investment market at the moment is still, for logistics, started off slow. It's nothing to worry about. The whole Dutch market started off slow in the first half of the year, slower than anticipated. At the moment, we're around the 600 million euros invested into logistics. This excludes the small box light industrial space. So that's more of the SME, the small and medium enterprise space. If we would include that, the market is double in size almost, and our year-end forecast is that the market for industrial and logistics for investment volumes will reach around the same level as in 2024, so 2.5 billion euros invested into Dutch industrial and logistics space. Which is important over the long period of time is how institutionalized the market has become. So we talked about niche markets this morning. 10, 15 years ago, logistics was a niche in the Netherlands. It was half in size. Now the Dutch logistics market is around 50 million square meters in size. Back then, it was only 15 million square meters in size. So the market grew, it institutionalized, ownership very institutionalized, and we saw the share in terms of total investment volume in the Netherlands, comparing that to offices, retail, residential, etc., that has grown to a quarter of the market. 20-25% of total investment dynamics in the Netherlands is being related to industrial and logistics real estate. And that's probably not going to change, and it's heavily impacted offices, for example, which was very dominant 10 years ago. Now it's much more logistics, and the Dutch market is much more equally balanced between all of those sectors. So a last slide to take you through pricing. It's always difficult to predict, so this is only looking back at this stage. So we've seen after the big change in rental rates and interest rates across Europe is how it impacted yields across all property sectors. So volumes back then went down 60-70% on the global real estate investment market, and there was a strong yield correction across all asset classes, especially prime, giving the low margin in terms of your financing rates. So yields went up from low 3.5% on a European weighted average to almost 4-5%. Prime net initial yields. Similar for the Netherlands. We had yields closing into 3% for logistics, and that has been changed to 4.75%. And recently we saw the first slight yield contraction. It's very small, I know, 5 basis points, but it's just to show our feeling how pricing, in which direction pricing is moving towards. We see more underbidders in terms of assets, portfolios. We see the willingness to do larger deals coming back. The share of foreign capital is growing in industrial and logistics. So all kinds of positive signs which impacted our forecast for the next 4 to 5 years, where we definitely see yields with hopefully also from further interest rates hikes coming down even further. As you can see, there already are some markets which already showed some 20-25 basis points correction. Those are markets which have yield levels also slightly higher than the Netherlands, were impacted stronger, and they are definitely already seeing some appetite from foreign investors, private equity investors already impacting those prime net initial yield levels. Last slide is a summary on what I just told. So what are we seeing for 2025? Stabilized occupational market. So don't think about those record years, think about the long-term trends, then we're still in a very okay, quite good year, but your rental rates will not see that double-digit rental growth. It will be more around 2 to 3% rental growth on an annual basis. That's what we foresee for the next 4 to 5 years. And investment appetite for all asset classes, especially industrial logistics, is definitely coming back, and there's much to expect from the sector in Q3 and Q4. So the brokers are very busy. Hopefully that will turn into still a very nice year, and that we'll definitely see coming back into 2026 more deal activity across all sectors and also logistics. Thanks.
Great, thank you, Sven. So we have Dominique Kouwenhoven-Schillings. Is that a good version of that, Dominique? Challenging for me, but good. And Eva van der Pluijm-Kok.
That's fine.
Excellent, very good. Eva is Vice President, Head of European Research and Strategy at Prologis, and Dominique is Co-Head of Transactions and Head of Asset Management for the Netherlands for Aberdeen Investments. And then we also have Ethan van Embden, who's a Director at Hines, looking at the logistics sector here in the Netherlands. So let's maybe just kick off, I suppose, with let's kick off with you, Eva. I think in terms of, I suppose, how you're seeing the demand-supply dynamics. What do you see? Is it, are we talking about a supply story? Is it a demand story? What's your sense of that?
So a couple notes. So our data is very different from your data. Oh yeah, sorry, the microphone. My data is very different from yours. So 24 was actually a really quiet year per what we saw, and we saw actually at the end of 24 demand coming back. But it is very, very slow. So very lengthy decision making. But I think the Netherlands is really not a story about demand, but it's a story about supply. It's just incredibly difficult to get anything online. And honestly, when we think about investing in the Netherlands or like anywhere in Europe or even globally, we think more about where is that supply-demand imbalance the greatest, right? And that's why we have such a high conviction of the Netherlands, because it's so incredibly difficult to build in this market. So obviously we know about nitrogen. This is something that affects everyone. We know about the boxification of the landscape, but there's also other complications. We had a meeting with our investors, when was this? In June, where one of our market officers was telling about a development we were doing. It's a redevelopment, brownfield of course today, but maybe it was a bat habitat. So we had to put up cameras, wait for a year to see if there were bats. Turns out there are bats. So we had to put up like special nests for the bats and see for another year if they would use those separate nests. So that delayed the redevelopment by 2 years. The cost of adding that to a development is incredible. That makes development so complicated in the Netherlands, beyond like all of the things that were mentioned in the research presentation. So I think it's so exciting to invest in the Netherlands because the rental outlook is great, because it's impossible to develop.
So from your side, the market is going to be driven much more by supply than demand. Interesting to get other people's views on this, because obviously the fundamentals of the market are between supply and demand. So how do we see that? Ethan, what's your perspective? And it might be useful as well, just for those who don't know Hines, just to give a brief view on where the capital is, where you're investing specifically here.
Here in the Netherlands, okay. So I fully agree on the supply side with Eva. Do you hear me? Yeah.
You might need to hold it just a tiny bit closer.
A little bit closer, yeah. This one. And here in the Netherlands, what we're mainly focused on right now is reversion plays within 5 to 7 years still for our core plus vehicles. Not sure if
very similar.
Very similar. I've heard the same stories across the market, and we're also looking at forward funds, forward purchases. Could be pre-let, partially pre-let, or speculative. The speculative ones need to be in top locations. Leasing market there is driving these decisions. And key factors there, or key focus points would be, power availability, obviously the specs of the building, and exit liquidity is also very important part of decision making for us.
Okay, good. And just in terms of the demand supply side, are you with Eva on that, and that you think supply is going to be the key element? That's what's going to be driving some of the opportunities here?
Fully. As I already mentioned, fully agree with her.
Okay, good. Dominique, do you agree as well? What's your sense of that? I'm going to pick up on the demand drivers as well in a minute, because it's interesting.
I'm not 100% agreeing, to be honest. but we can have our disagreement on a few points. I do believe that there's still demand, but I think that we have reached a maturement in the logistic market. So what you've seen from 2015, 12. There was a large proportion of developments and larger growth in the logistic markets. There were also more investors eager to purchase logistic assets, and I do see that that's stabilizing now. So also what we see in the market is that there are a lot of large logistic partners that have found their spot in Europe and are more looking for a campus growth, stabilization, optimization of their electrification of their warehouses, less staff. So you see that they found their spot, but they're more looking at how can we mature our business. And I think there's a potential for us as investors and developers to see now it's not only a big box somewhere in a field, but it needs to be a campus, it needs to be an office, it needs to fulfill all the demands of a logistic partner that is growing into the market. So 50-50 agree with them.
I don't think it's very different from what my perspective as well, but I'm just saying demand has moderated. So I think that's pretty similar. It's maturing indeed. It's not at those peak volumes anymore. Right now it is still slow. The interesting thing is, though, what we're seeing when demand is signing, they want to occupy like the next day, because they're like, okay, let's push this decision out as far as we can. And at the last minute, when like basically the barge, it's coming into the barge, like that's when we need to sign, because we need to actually occupy the space. But overall, indeed, it's more about consolidation, optimizing the space that they have. But this is not only, I feel, part of it, yes, it's a maturation of the market, but it's also because there's no other option, right? You're going to lose labor, you're going to lose any like advantage you have by what you've built in that location. So I think it's also kind of, there's no other choice but to optimize the space that you have.
Okay, good. That one is going to be for you and Sven, Dominique. That one. So keep that one for you. And in terms of the demand drivers, you spoke about some of those, Sven, but Dominique, it'd be interesting to pick up from you. How are you seeing those in terms of, there's, for example, a lot of discussion around defence, a lot of discussion around nearshoring. Sven mentioned Asian companies moving in. You're seeing larger retailers, for example, more people looking for space. So what's happening on the demand side?
Yeah, I think there's a different group coming to Europe. So we do see that there are larger Asian. I don't think it's working, Richard. To be honest,
it is honestly.
Yes?
Yeah.
Oh, I'm sorry. Yeah. Okay, good. No, we do see some larger Asian investors or companies that want to get into the European market. So there's requests coming in for us to develop locations on the demand side, and I totally agree with Eva on employment, because I think that's a really challenging point. Apart from what Ethan just mentioned, the net congestion, getting labor, getting actual people into to working at your business makes it very challenging for companies to grow in the Netherlands. So they're rather looking at the eastern part of Europe, where the labor costs are lower. There are more employers on a different set of skill sets than we have in the Netherlands. So that is, I think, what is challenging for the growth.
And interestingly, one of the things that came up in the sessions that I've been doing is the importance of availability of energy, so that grid topic, but also absolutely right, that available of the ability to be able to have employees who are ready and able to actually service those occupiers when they come in. And one of the bigger topics also was around the defence side, obviously with Europe spending significantly more, budgets going up to 5% or beyond, particularly also in Eastern Europe at the CE1 yesterday. That was a big topic. How do you see that, Sven? How do you see that? Is that something that is going to also impact this market versus other European markets?
Yeah, it will definitely impact not only logistics, but the whole landscape of the Netherlands. We have a shortage of space, so I think the supply story and the challenge is definitely the long-term challenge in the Netherlands. And now with defense asking for more space, we have an additional competitor for the same space. So that will definitely impact on those locations. When defense starts to locate in a certain region or area in the Netherlands, it will bring additional business as well. It needs logistic facilities, it needs homes. So it will definitely have an impact on the demand for space in the Netherlands, and it's not only exclusive to logistics.
I just like, the only thing I think is that it's the location that's different, right? So what I've heard so far is that the requirements have been concentrated in Flevoland, like around Lelystad, which, like, I think per your presentation has a vacancy of 7.5%, right? So I think the availability of land is there, and honestly, they don't need to be in southern Netherlands, and they're probably going to opt for a cheaper location where there is some land available. So I do think, yes, it impacts the demand, but maybe not so much in the core locations as we'd like. We would see probably a lower impact on demand rather than in the secondary locations. I think that's my conviction.
It was interesting as well. So we did a session at Transport Logistics, which is every 2 years in Munich. And for those who go to Expo Real, it uses all of the halls plus all of the outside. So there are actually trains and trucks and everything already there. So it's a massive fair. And one of the topics there was also, from the real estate perspective, competing for land as well. So that data centers looking for similar land, other places beginning to look for land. And so actually the supply side that you mentioned as well, Eva, is actually, if anything, going to get tighter across Europe. So I don't know whether that's something that you're having to think about. Dominique, also interested to get your perspective on that, perhaps. Just in terms of the constraint on supply and whether or not actually it's getting more difficult also because there's other people competing for that same land. Are you seeing that or not? If
No,
you're
no,
not, it's
no,
quite-
no, no, no. I'm agreeing with that because, well, we are a small country, so in the whole of Europe, and looking at what we have achieved with the logistics and the banana that Sven was referring to, I think that occupation is a problem. But I do agree with Eva that not in all locations. So I still believe there is room for development and growth. But then we have to compete with all our permit and regulations in the Netherlands. So getting that up to speed, that's the challenge.
Okay, good. Ethan, happy to get your views on this, but also, obviously, Hines, active US, active globally, active in Europe. When the investment committee is looking at the Netherlands, how is that seeing it in terms of the logistics space in comparison, I suppose, to other European destinations for capital? Where are they seeing the opportunities? Where are you seeing the opportunities?
Well, our IC is constantly comparing like the Netherlands with other European countries. I would say Netherlands is on top of the list when we're talking about logistics. It remains a gateway to the rest of Europe. We have Rotterdam, we have Amsterdam as key entry points. And from there, through the logistics banana, you can move into the hinterland, to Germany, the Rhine-Ruhr area, and the rest of Europe. For us, that's one thing why we're on top of the list. Second of all, there's great infrastructure within the country. And again, I don't want to move back all the time to the supply constraints in this country, but that's driving rental growth in top locations, which compared to other countries in Europe makes it a very favorable investment case. Okay, good.
I was interested, Sven, as well, looking at the vacancy rates there, where you'd got one, I think was as high as 12.5%, 12.5% versus some down sub 2, for example. So is that an issue with that particular local market? Is it oversupply? Is it just that is no longer a useful location any longer? What's driving that? Because that's a real bifurcation in the market. I mean, that's a...
It is important to mention logistics is of course a fast-moving market. It can be, for example, the Amsterdam vacancy rate is just one big asset still being vacant. When that's leased, the vacancy will drop immediately below that 4-5% level. So with big boxes, it can change quite quickly. So we don't want to say that these locations are not in scope anymore or not in demand anymore from an occupier's perspective. It can always be a very micro challenge issue with the location in terms of infrastructure. There's assets which are vacant for a longer period of time. There's always a story to tell and to explain why it's still vacant. Because there is strong demand in the market. It's as moderated as seen on the slides, but modern logistic facilities which are vacant for a slightly longer period in time, they require a story, and there's always a story why it hasn't been leased yet.
And is that also an opportunity, I guess, in terms of these where you've got high vacancy? Is it that the location is actually sound but the asset is not, and therefore an investor can come in, transform that? Is that an opportunity, or it's just a bad location and people just have to accept it?
It's a nuanced answer. In the booming years, we've seen some developers, investors going into more exotic locations. Then you can have the best building in town or the region or the province, but then the location attracts less demand. So then your leasing time requires some additional period. But in general, what we are seeing from JLL's perspective, if we zoom out to the whole industrial market, almost 40% of industrial estates are becoming obsolete. And the market is around 220 million square meters of space. So that offers a huge opportunity to look at that brown to green play, as Eva mentioned. It's of course a more challenged play, but it has zoning in place, it has an electric connection already. So we do see huge opportunities there. There's old facilities with a lower floor space index, so you can utilize the land even better than they did 10, 15 years ago, or even 20, 30 years ago. So I think that's where the huge opportunity is going forward, and not only to look at greenfield developments.
Yeah.
My question to you is then, are you only talking about big boxes, or are you also talking about urban last mile, mid-box, logistics?
Yeah. The 200 plus million, that's all. So it comes from urban industrial space, light industrial, small box, looking at the whole industrial market, and try to look at it in the relationship to the shortage that we have also for homes. We need to build 1 million homes in the Netherlands in the coming 10 years. But what the parliament often forgets is that they need to work somewhere as well. Not everyone, as us, works in an office. They need to work in industrial space. So we need to create that extra space. The market needs to grow. And we calculate that for each home we need to have 17, 18 square meters of extra industrial space, around 8 square meters of logistic space. And that needs to come somewhere. So it's definitely a supply challenge going forward. And I think the opportunity lies within brownfield redevelopment, because I don't foresee the Dutch government changing their perspective on big box developments or industrial developments.
One point on that. So Sven and I were yesterday at another logistic conference, but they're one of the, I think one of the hotspots, the municipality of Waalwijk was also present. And they have a challenge. So they have land available, but as Sven is mentioning, the big boxes, that convincing the municipality, the board, the members there, that big boxes should still be developed, because they're creating employees, people to come to Waalwijk, growing the city of Waalwijk. But the combination, and that's what he was looking for, is to see how they can be part of the community. So making sure that people actually are able to work there, but also housing, so migration, people that are coming in that you can supply there. So they're really thinking about a larger development. So if a developer would go and opt to purchase one of the lands, they have to have a plan about how to redevelop not only into logistics but also into residential and infrastructure.
Okay, good. Ethan, it'd be interesting to pick up from you just in terms of, I guess, asset types, and interested in anybody's view on this. What's gaining most traction in the market? You mentioned, is this big box? Is it urban logistics? What are the investors looking for in this area? And also, and I realise this could be a whole conference in itself, but what is last mile in the context of here? It's clearer in some markets, but obviously you've got cities blending into one another, and short distances between large cities. So how do you look at it in this market?
I would first start that every investor probably defines last mile urban logistics in a different way. How I would define it here in the Dutch context would be, I would say, assets up to 10,000 square meters, let's say located within the urban ring, around a 30-minute drive time, like 30-minute drive time from the catchment areas. From our perspective, as Hines, we do like to add alpha, how we say it. So we're not, let's say we never ride the wave just on yield, but we would like to add value through active asset management. Therefore, we're also looking at these smaller, more granular types of assets. These strategies are scalable, and there have been previous exits to bigger logistics players where they've bought these portfolios. So that's one focus area. Another focus area would be the mid-box assets for us, which would be, again, depends on the definition per investor, but we would say between 10 to 30,000 square meters. Leasing market is very strong there, and across Europe we see a lot of opportunities in that space. Big box, I fully agree with Sven. You need to very much focus on the prime locations. I think big boxes would always work in these locations, but the moment you move outside of the prime locations, it becomes a bit more challenging. And from a Hines perspective, we're also looking at specialized logistics. Think of cold storage, conditioned storage. We have 2 fresh parks in our portfolio: Fresh Park Venlo, ABC Westland, food and agri logistics parks. And what you do see there is, from the investor perspective, you do see a discount to prime, or a premium to prime, however you want to call it. But the fundamentals of these parks, of these ecosystems, are so strong that when you believe and actually invest in it, they turn out to become very strong investments.
Okay, good. Yeah, Ava, it'd be good to pick up any of those points about you as well.
Yeah, I know. That's I felt the reference like very directly to Prologis, but so a couple of things. So we as Prologis define last mile to be only Paris and London, because that's the only cities where you really need to be like out, like in the city, to be able to deliver within the city. But we do qualify also city distribution, and I think it's a really interesting sector. So let me just first comment on that, because I think, well, I'm going to include us, like we've also made mistakes, because it's kind of difficult to kind of decide what does the customer want, what do they need. So we've made the mistake in Amsterdam also to develop too big. We had 10,000 square meters, but no one wants 10,000 square meters in the middle of the city, right? That's the same thing that's true for that big asset in Amsterdam that's vacant. That is unfortunately a complete mismatch of what's like required in the market versus what actually was built. So, and we had to divide the asset, and then it was leased, right? So when it was 5,000, then and finally it kind of aligned with the demand in the market. So that's things you'll learn. I think it's a sector that's still in development. And I think you're right about like Venlo, markets like that, you see that the core is so strong, the vacancy is so low that the outlook remains very strong. I was actually talking to my team last week, and we've actually recorded negative rental growth already since 2024, because we record net effective rental growth, so we include concessions. So we saw concessions already rise in 24 and in 25, and now they're kind of almost stabilizing already. But actually they're expecting in Venlo already in the near term growth, because the market is so constrained and the demand is still strong. But I would say it's very small locations. Overall, it's more a rising concession story still, but it is still a very strong location where for the big box, you can really still see a core profile in terms of returns.
Building the right thing in the right area.
Yeah.
Is it that the market changed for that? So the alignment changed, and is that something that we're going to see going ahead, where maybe what was a core, A location becomes an A- location, or a...
I do think it's expanding. I do think in the Netherlands, because so many markets like Tilburg have just been completely built out, that customers are moving a little bit more secondary. I would say it's not like BC, but it is A-, like you said. So I think that's indeed a little bit of the movement that we see. I think also there was a lot of capital in the market around 2020, 21, 22. So some of these investments that were made or developments that were made were just, again, not suitable for the market. And again, this one asset that I keep thinking of is really a prime example of that, where it just didn't align. And it was just money flowing into the market. So.
Okay, good. Dominique, Ava mentioned there the capital. It would be good to just pick up on the capital flows, what we're seeing. Are we seeing, different types of capital coming into the market? And it'd be interesting to pick that up with you, Ethan, as well.
I want to say yes, because we are now in the selling mood at the moment. So we do see that there's a lot of appetite, and even surprising us with how much appetite there is, and parties that are approaching us and want to do off markets. So yes, I agree with Eva, there is a lot of capital still in the market. And also for good locations, they're very interesting to see. Also family offices, surprisingly. So a lot of capital there that are very eager and can bid very sharp. So that's pushing the investors to a certain point that we are surprising to see where it's going.
Okay, good. Ethan, it'd be interesting to pick up your point on that as well.
We're in the buying mood. But in terms of equity raise for our core plus and value add strategies, we see repeat investors stepping into the new funds, but we also see new investors, institutional, but also like Dominique just mentioned, on the private wealth side, where there's huge untapped potential, which we see, and you probably agree. I don't think there's a constraint on capital in the market right now.
Okay, good. And just to pick up some of the previous panel, what are we seeing for logistics in terms of financing? Straightforward for everything? And then also it'd be interesting to pick up on the sustainability side that was coming through in the first panel as well. But let's start with the financing one.
Yeah, we just had a brief conversation about financing, and I think that for the Netherlands it's very challenging because we're competing with ourselves in Europe, but also for the Asian market. So if you look at what transfer tax is doing in the Netherlands, making the sums and making sure that it stacks up, we don't see it at the moment. So I think that the Dutch government has overrated itself in what they believe to think about the Dutch real estate market. Getting the transfer tax for residential back to the 8% is just saying that that they've done a wrong calculation and it should be lower. But if you look at the logistics, the transfer tax is making it impossible for us to invest. So our investors and our own funds rather go to other countries than the Netherlands.
Okay, interesting. Does anyone want to?
Yeah, no. On the transfer tax point, you do see a lot of club deals happening right now in the market, where family offices sometimes, the very limited cases, partner with institutional capital, but you always get then the governance discussion: who has control? How do we make decisions when one party wants to sell and the other partners would like to stay in the deal? So that's a very important topic. But yeah, as you said, on the residential side, this is making it very difficult for international capital. It's we hope something will change soon on the transfer tax side, to be honest. Yeah.
Okay, good. In terms of the occupier side, one of the things that was coming through quite clearly in, I think, all of the surveys that were done that I've been working on over the last 4 weeks was occupiers concerned about energy supply, so that being a key element of it, but also costs and rent increases. So I suppose, how do we square these elements? Sustainability, obviously, the more we can do with renewable energy, the better that is in terms of controlling costs. But we've mentioned constrained supply here, but you mentioned also, Sven, that there's more difficulty we're not to expect rental increases, but surely if we've got constrained supply, we're going to get ultimately those rental increases. So how are we balancing those two things?
I think that's the difference between what I think to see is short-term and long-term trends. Short-term, I think that rents will remain relatively stable. In some areas might, as Eva mentioned, if you look at also what incentives have done, there's already a decline in rental rates, prime rental rates. Over the longer term, given the shortage that we have, rents will definitely continue to go up. Rents luckily aren't the biggest expense from a logistics operator's perspective, so there's more to look at. There's labor to look at, there's your transport costs to look at. It will be a very tricky play to keep costs in a relatively stable measure and not to relay all the costs to the consumer if it concerns a retailer or something which impacts consumer goods.
Okay, good. Last question to everybody, because I want to keep us on time, and there'll be opportunities to ask questions in the break afterwards. There's a lot of room for networking and questions. Do we see the sector retaining its attractiveness? At the moment, it's kind of, in terms of the larger scale investment opportunities, living and logistics has been really top for the last couple of years. Then you do have data centers and other areas coming up. But obviously in terms of scale, this is a significant element. So do we see it as retaining its attractiveness? Let's look at over, let's say, 24 months. And if so, where do we see the opportunities? It doesn't need to be necessarily a specific one, but in general, where do we think the opportunities are going to be if we had to invest? Should we start with you, Sven?
I'm the only one not working from an investor. No, what I think in 24 months, I definitely see the attractiveness of logistics, industrial, keeping their momentum or increasing in momentum. It's something that we are already seeing. Just to bring in another voice, we are talking about logistics, but I think it's much more around that urban space closer to cities, where there's that real competitiveness for space, for land. I think those locations will increasingly be pressured for residential purposes. So either you have golden hands for industrial, or you can repurpose in the future to resi. Those locations are becoming scarcer and scarcer because the municipalities are pushing away industrial estates further away from the city. So I believe in those smaller locations close to the city.
Okay, great. Dominique, where, what and how?
Well, I have to say I totally agree with Sven. So we do see, and just mentioned that we are in the selling mood. That was for the big boxes, but we are in the buying mood for launching a fund for short mile, last mile. How do we call it? But
yeah.
no, Ethan just mentioned till 10,000 square meters, or we take it a little bit higher to 20,000 square meters. That's where we do see the potential, and that's where we will be investing in the European market.
Okay, great. Ethan.
I still see most opportunities within, I think, comparable to Dominique's answer, but also in the last mile space, also in the mid-box space, and again, limited big box opportunities. There are only a handful of big box assets available. If they come available in the best locations, everyone jumps on them. So I would say most opportunities lie within the urban last mile and mid-box asset sizes.
Okay, good. Ava, what's your view?
So I think logistics in Europe or in the Netherlands is still really attractive. I work for a global company, so when I compare it to the US, where supply barriers are a lot lower, where the vacancy is close to 8%, and in Europe it's just above 5%, it seems like very attractive, and that's because of the supply barriers. So we have still really high conviction on core locations. I would say redevelopment, I think, is super interesting, because if you have the capabilities to get those developments online, you can really get some attractive returns that are higher than, I would say, a normal core risk return. So I think that's where a lot of opportunity lies.
Okay, good. And I haven't read it yet because I think you only
Yes.
published it yesterday.
Yes.
But you do have a new report out on that.
Yes.
Which is your opportunity now
Yes.
to mention it.
I work for a global company, so I am rarely allowed to talk about Europe. But we finally published a European paper. It's about persistent supply barriers position Europe for value growth. And I specifically highlight the Netherlands as the most difficult place to build in Europe. So the paper is on the website.
Great, thank you. And just continuing a tradition that we had, the last time we did a session here in this office that was a morning one, there was somebody else who was also due to give birth the following year. Yeah. So I'm delighted that we're continuing that. I mentioned at the time that that possibly, because Richard was no longer a very popular name, that it might be good to bring that up. I don't think that did happen on that occasion, but I'm still holding that out as a hope for you, Ava. So, you know.
Delivering a birthday, so
Great. Super. Really interesting discussions this morning. Thanks very much for being here. Look forward to the coffees now. There's 45 minutes, I think, an hour of opportunity there for coffees and discussion. So let's use that. I look forward to speaking to all of you in the break. Thanks very much for joining us. And thank you to all of our speakers. Thanks very much, everybody.